Hey everybody, in this video we're going to talk about terminal value. And so the purpose of this channel is to help the audience learn all about hedge funds. This video will teach you about one of the critical tools in valuing businesses or assets, and that is terminal value. This video is for educational purposes only and is not investment advice. By the end of the video, you will have a basic understanding of terminal value, which will help you first understand the finance literature and valuation methods, and then hopefully after more videos and more work, run your own valuations. Watch the video until the end to make sure you have a rock solid understanding of this valuation method, so you know it later for your academic and professional career. And two, there will be a short quiz at the end. Please feel free to post comments with any questions or any topics you would like to see covered, and don't forget to smash that like button. So what is the value of a business? It can be calculated in multiple ways. However, one way is by calculating the present value of future free cash flows. And by future free cash flows, we mean the amount of free cash the business generates every year to pay to its owners. And the present value is when we discount each of those back by our weighted average cost of capital to get it, because to get all of those cash flows back from future period values to today's value. Okay, so then what is terminal value? So here we can see we have some total revenue, we've got some EBITDA, we've got some unlevered free cash flow, right? And so, for example, let's say we're in 2022 now, and so we expect the company to generate 13.8 million in unlevered free cash flow this year, 14.9 million next year, 16 million the following year, 17.2 the next year, 18.5 the next year, etc. Okay, and this is going to go on for an extended period of time. Let's say keep growing through 2033. Okay, well, the thing is we can't sum up all of these values into infinity, right? All like 13.8 plus 14.9 plus 16 plus 17.2 plus 18.5, and then discount them back. So at some time there has to be a terminal value, right? That's the value when we're going to exit the business, or the value when we are just going to calculate the sum of all of the future free cash into infinity, right? And so in this example, what we've done is we said, okay, we're going to sell the business after 2025. So right here. So our terminal value year is going to be like 2025 and 6 months. Okay. So we're going to have our terminal value right here. And this is going to be basically the amount that we would get if we sold the business, shortly after 2025. Okay. And another key assumption I want you guys to notice is the discount factor, or WACC, of 9%. And if you're confused by the weighted average cost of capital, go ahead and check out our weighted average cost of capital video. Okay. And then another key assumption I want you guys to know is the perpetuity growth assumption. And that means that we think that this business is going to grow, and this is for educational purposes only, but we think the business will grow about 7.5% per year in unlevered free cash. So every year it'll grow about 7.5%. Okay. And then so when we sell the business in 2025, or if we do the, just terminal value year this year, then in 2000, shortly after 2025, then what we need to do is we need to figure out, okay, we need to divide it by the discount rate, but we also have this perpetuity growth rate, right, of 7.5%. And so what we do is we adjust the weighted average cost of capital for the perpetuity growth rate. Okay. And so if the weighted average cost of capital is going to be 9% and the perpetuity growth rate is going to be 7.5%, right, then our final discount rate is the weighted average cost of capital minus the perpetuity growth rate of 7.5. So it's 1.5%. So the way that we calculate the future free cash flow is by multiplying the future free cash flow times, or divided by 0.015, which is 1.5%. Okay, and I'll show you that. It's a little confusing, but I'll show that to you in the next slide. Okay, so how is terminal value calculated? Well, there are two ways. Perpetuity approach, right, which is where the present value of the total value, and this grows at 7.5%, right? And we've got this weighted average cost of capital at 9. And so what you can see is that this is going to then give us, so the present value of the terminal value is 677 million, and the total present value of future free cash is 223 million. Okay. And so this is in the perpetuity approach, where it just grows and grows forever. Right. And then the second opportunity is the EBITDA multiple. And that's where we take the future free cash for 3 years at 9%, 51.9 million, and then we sell it in shortly after 2025. And when we sell it, what we do is we get a multiple times EBITDA. So it's 652 is the total value that we sell it for, basically, which is calculated based on the EBITDA times the multiple. All right. And we're going to go into this more. But so in this case, basically what we're doing is continue to hold the business forever, like a Warren Buffett type model. And in this business, what we do is we sell it in 2025, right? And the sale price is calculated based on the multiple times the EBITDA in 2025. Okay, and then less net debt, we subtract off the debt, add in the cash, and that's our implied equity value. And here, same thing. We subtract off the debt, add in the cash, and that gets us our implied equity value. So let's go through this perpetuity growth approach more carefully. So what we have here is we have the free cash flow of 12.7, right? We say it grows about 7.5% each year. So the following year, we'll get 13.7 million in free cash. Now what we do is, in order to calculate the terminal value, we have to divide this 13.7 by WACC, but then not just by WACC, but WACC minus the perpetuity growth rate. So we to get 915.6, we divide 13.7 divided by 0.015. And that 0.015 is WACC minus the perpetuity growth rate. And that gets us the future value of the terminal value. Does that make sense? So we've got our free cash flow, and then to get the terminal value, basically to get the future values of all these cash flows every year, right, which we're going to get by owning the business, we scale it by 1 over 9% minus 7.5%. So 1 over 0.015. And that's the future value of the terminal value. Okay. And then what we do is we discount that number back 3.5 years, right? Because this is in 2025 when we do our terminal value calculation. So we discount that back 3.5 years. Why 3.5 years? Because right now we're at the start of 2022. And this is, let's say, in the middle of 2025 when we exit the business or do this calculation. Okay. So then that discounts it back to the present. And that discount factor is 74%, right? And 74%, just so you know, is basically what would happen if you discounted it back, from 2025 to the present. And so that gives us a present value of terminal value of 677 million. Okay. And so our implied exit multiple is then, because our EBITDA at exit, we're expecting to be 26.5. Our implied exit multiple is 34.6. Okay. All right. That's the perpetuity growth approach to calculating terminal value. Then what we need is and this should say multiple instead of perpetuity growth. This should say the multiples approach. So the multiple approach to calculating terminal value is we say, okay, what will our terminal value be? What will our EBITDA be in 2026? And it's 28.4 is the assumption in 2026 or after 2025. The multiple on that is 31. And so that gets us a future value of terminal value 881.6. Okay. So we think, so if instead of doing it on a future value of terminal value, so instead of, summing up all of the future years of free cash that it was going to produce, instead we say, okay, we're just going to sell this for a multiple of EBITDA. Well, if we do that in 2026, we think the price we would get for it in 2026 is 881.6 million. So $881 million. But then again, we have to discount that number back 3.5 years until we get the 652. Okay. So as you can see, the terminal value of holding the business forever and the free cash seems to get us more money than selling the business at an EBITDA multiple. Okay. All right. And we determine the EBITDA multiple by analyzing trading comps. And so you can see that here. And what does trading comps mean? It means we go and look at other similar businesses, public or private. And if we can figure out what their EBITDA, their total enterprise value divided by EBITDA was at their exit or currently, then, and it's being purchased today, then this is how we get our multiple. So you can see here, 33.6 is the average, and I think 32.2 is the median. So this is the median, the average and the median on EBITDA when the company gets sold, right? So that is how we come up with this 31x multiple. It's by looking at trading comps. We say, okay, the median is 32.2 of other publicly traded companies or private companies that have recently exited, and the mean is 33.6. So, okay, we're going to say 31 in our terminal value calculation. And similarly, the implied exit multiple is 34.6 when we do this perpetuity growth method. Okay, so pop quiz. What are two of the ways to calculate terminal value? Two of the ways. Anyone? Perpetuity growth method and the multiples approach. So in the perpetuity growth method, we're just adding up all of the future free cash, right, in the terminal value year, and then we're discounting back to the present. In the multiples approach, we're taking the multiple, right, the multiple of EBITDA or the multiple of revenue, and then we're getting a value on the business in the exit year, 2025 or 2026, and then we're discounting that back to the present. All right, thanks so much. Don't forget to like this and also post any questions or comments you have in the comment section. If there are other videos you want to see, let us know, and we'll make those videos for you. Thank you so much.